By May 2026, on paper, the global economy looks invincible. The S&P 500 recently climbed past 7,500, and the Dow broke the 50,000 mark. But this relentless climb relies heavily on the artificial intelligence boom. Tech giants are carrying the entire market, with hardware providers like NVIDIA recently crossing a $4 trillion valuation. If you look closely at the math behind these numbers, the dashboard is flashing red. The first warning sign comes from the Shiller CAPE ratio, developed by Nobel laureate Robert Shiller to measure stock prices against long-term inflation-adjusted earnings. This chart shows the 140-year history of the Shiller CAPE ratio. The historical average sits at 17.3. Today, the S&P 500's ratio has reached 41.6. The only time it was higher was at the absolute peak of the dot-com bubble in December 1999. We see a similar story when looking at the Buffett Indicator, a tool Warren Buffett popularized, that compares the total value of the U.S. stock market against the nation's gross domestic product. A fairly valued market typically sits around 100%. As of late May 2026, this ratio has pushed past 200%. Buffett noted buying stocks as this ratio approaches 200% means you are playing with fire. These metrics tell us the stock market is priced for absolute macroeconomic perfection. But when you look beneath the tech stocks, the foundational economy is actually fracturing. The most immediate pressure on the real economy stems from the Middle East. Ongoing military conflict between the U.S., Israel, and Iran has resulted in the de facto closure of the Strait of Hormuz. This narrow waterway handles roughly 20% of all global oil and liquefied natural gas shipments. With that physical flow severely restricted, supply chain and energy costs are rapidly spiking across the manufacturing and shipping sectors. Financial markets are largely brushing this off as a temporary disruption, assuming a quick diplomatic resolution. It's a dangerous echo of the 1973 oil shock, where optimism gave way to a 300% spike in crude prices and a brutal recession. At the exact same time, a highly chaotic international trade policy environment has triggered the implementation of Section 122 tariffs. This imposes a strict 10% tax on the vast majority of imported goods, adding a massive supply-side cost for corporations. This is a chart breaking down the U.S. Consumer Price Index for April 2026, which printed at an alarming 3.8%. As you can see, energy commodities alone drove more than 40% of that total inflationary gain. With these price hikes bleeding into structural areas like housing and services, inflation is deeply entrenched. The Wall Street narrative of a smooth, painless return to the Federal Reserve's target rate is mathematically broken. Faced with sticky inflation and emerging cracks in the labor market, the Federal Reserve is paralyzed. In their late April meeting, a deeply divided committee voted 8-4 to leave interest rates exactly where they are. This keeps the federal funds rate elevated between 3.5 and 3.75%. That maintains a crushing cost of capital on mid-market corporate borrowers and everyday citizens seeking loans. That citizen pressure matters because the American consumer is the true engine of the economy, driving roughly 70% of total gross domestic product.
Here we see the S&P 500 logging consecutive winning weeks on the top line, while the bottom line tracks the University of Michigan's Consumer Sentiment Index. That index has collapsed to a historic low of 44.8, driven largely by declining real wages and surging gas prices. The labor data reveals why sentiment is so poor. While the headline unemployment rate holds at an optical 4.3%, the real unemployment rate, which includes people forced into part-time work for economic reasons, has reached 8.2%. Corporations are actively slashing hours to survive high borrowing costs, pushing nearly 5 million individuals into part-time status. When the consumer base is actively cutting back on spending to survive, broader corporate earnings outside of the AI sector have no mathematical path to sustained growth. While commercial banks look stable, massive systemic risk has migrated into the opaque, unregulated shadow banking sector known as private credit. This market has ballooned to an estimated $2 trillion in global assets. Private credit borrowers generally have lower credit quality and higher leverage than public companies. With the Fed keeping base rates high, these floating rate borrowers can no longer afford their debt, causing corporate defaults and bankruptcies to accelerate. This distress is triggering a slow-motion liquidity crisis. Panicked investors submit massive withdrawal requests to pull their money out, with funds seeing redemption demands that far exceed standard quarterly limits. The Financial Stability Board warns that these private funds are deeply tied to regulated commercial banks. This creates a hidden contagion vector directly mirroring the systemic vulnerabilities that triggered the 2008 financial crisis. When private funds are forced to sell off illiquid assets at deep discounts just to meet withdrawal requests, it introduces a severe credit crunch that chokes off capital for businesses nationwide. We currently have a historically expensive, AI-obsessed stock market resting squarely on top of a fracturing, stagflationary economy. Markets stretched this tight require a massive extraction of liquidity to pop. That catalyst is arriving, in the form of an impending $80 billion initial public offering from SpaceX. Absorbing $80 billion in public capital requires immense institutional financing. Analysts call this capital diversion risk. To afford this massive new offering, investors will be forced to sell off their existing tech megacap holdings. If that liquidity dries up at the exact moment investors realize AI infrastructure spending cannot scale exponentially forever, the sector faces a violent 15 to 25% multiple compression crash. For young investors looking at the heavily bearish outlook over the next 2 to 6 months, the strategy is simple: exercise extreme caution. Do not panic and refuse to pour your savings into highly hyped tech stocks all at once. Build a diversified portfolio slowly and save cash to buy great companies when prices fall. In the stock market, consistency, patience, and demanding a true margin of safety will always outlast a disconnected narrative. Eventually, macroeconomic reality always reasserts itself.